Essentially what happens is because the U.S. corporate tax rate right now is so much higher than other countries, multinational companies have a very strong incentive to take production, especially of intangible products like technology and drugs, and make it look like that production took place in other countries. That minimizes their U.S. tax and increases the profits in low-tax countries like Ireland or the Bahamas. The idea behind this change is that when you lower the U.S. tax and then put in some new measures that are meant to prevent the shifting of profits abroad, maybe some of that production will start getting booked in the United States instead of other countries. Our exports will magically seem to go up higher and imports will go lower, cutting the trade deficit. The key here, though, Kelly, is that even though measured GDP goes up and the measured trade deficit goes down, nothing real in the economy actually changed.
But now here's what I find interesting about this, that you could flip this in reverse and say, well, wait a minute, if they're booking all of this overseas for tax purposes, then maybe the trade deficit wasn't so bad and growth was better than we thought. Because if it's just a wave of the wand now, then couldn't you just wave it retrospectively and say, actually, everything wasn't that bad?
I think that's actually a very valid way of looking at it. And essentially, these transfer pricing tactic, as we call them, was holding down how much U.S. companies, especially our most successful intellectual property type companies, like in computers or drugs, it really held down how productive they really were. Getting back to reality creates almost this one-off bookkeeping change. I would draw an analogy to in other countries where they would bring in tax systems that exposed the underground economy and brought it into the light of day and made it legal. Magically, GDP gets bigger overnight. But the economy didn't actually get bigger. It's just that people used to do stuff that wasn't showing up in the official books. Suddenly it shows up.
Hey, Greg, aside from these kind of bookkeeping adjustments that you're citing here, what do you think the effect's going to be on corporate incentives in terms of where they invest around the world? Will it truly level the playing field? Will it necessarily cause a big change in where they are? Because it seems to me companies want to be where the expected growth is for the most part.
Well, I think that's exactly right. And if you think about the reason companies have outsourced production in the last decade, 20 years, is to places like Mexico and China that don't have especially low taxes, but they have cheap labor. That differential is not about to change overnight. Where this tax bill does really make a difference is in things like, where do you put your head office? We have seen so many companies move their head offices to other countries, partly to escape the very high taxes in the United States. Maybe some of that will reverse. And head office jobs are very good jobs. And there is some evidence that companies tend to put more of their high-valued activities, like marketing and R&D, near where their head offices are.
Greg, I like that you point out, because a lot of these accounting identities have to add up. So if all of a sudden the trade deficit isn't that bad, it could mean that our investment income surplus also isn't as good as we thought, right? Well,
exactly. So essentially what happens is stuff that used to get labeled as profits on foreign subsidiaries gets relabeled as exports. So in fact, the gap between the U.S. and the rest of the world is exactly the same. We just label it differently. And magically you'll see, hey, we're exporting more, but now we owe all this money to foreigners for all those huge debts we've been building up. And Kelly, if I could make one final point here, the optics here are very important. As I just said, this doesn't actually mean the economy has changed. But if you think of Donald Trump's point of view, which is that he really hates the trade deficit, if he can say, hey, this trade deficit is smaller, I mean, you might actually say, well, we don't really care if nothing actually changed. If that means the president is going to pursue less aggressive and confrontational trade taxes with other countries, maybe that can calm down some of the protectionist-like tension that's been building.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.